XRP has kicked off 2026 with force, up 18% in the first week alone. Why is this happening? Three converging drivers: over $1 billion pouring into spot ETFs, a tightening supply crunch across exchanges, and the regulatory weight finally lifted after the SEC case closed in August 2025. But the real question everyone's asking is simple. Does this move have enough fuel to push XRP over $5? Based on the data, yes, it can. Before looking ahead, we need to understand the ground we're standing on. XRP's spot ETFs have attracted steady institutional inflows, even when the broader market was red. Meanwhile, exchange reserves have fallen to their lowest levels in years, forming a classic supply-demand squeeze. And of course, the SEC win removed a multi-year anchor that had suppressed institutional participation. Yet price didn't reflect those fundamentals in 2025. XRP closed the year down 21%, sliding from a July high of $3.66 to around $1.85 by December. Fundamentals were strengthening, but price lagged behind, creating today's setup. Catalysts that could push XRP toward $5 and beyond. XRP in early 2026 is sitting in a rare position, where fundamentals, regulation, and macro conditions are finally aligning at the same time. For years, XRP had the tech, but not the environment. Today, the environment is finally catching up. We are no longer talking about isolated headlines or hype cycles. We are talking about a chain reaction, where every improvement in policy amplifies ETF growth, every ETF inflow amplifies liquidity depth, and every liquidity expansion strengthens ODL demand. This is the closest XRP has come to a synchronized tailwind since its inception. So now, let's break down the 7 catalysts that are forming this alignment. 1. The Market Structure Bill. The Senate is now reviewing it, with a floor vote expected in Q1 2026. When the House approved it in July 2025, XRP jumped 14.69% in a single trading day. Full passage removes the compliance barriers blocking institutional allocators. 2. ETF momentum scaling. Rapidly, 5 XRP ETFs captured $1.07 billion in their first month. Thanks to updated SEC generic listing standards, new ETFs can launch in 2 days instead of 240. WisdomTree's fund is next, and analysts expect 100-plus crypto ETFs to hit in 2026. Standard Chartered projects $8 XRP if inflows continue. 3. Actual banking usage, not demos. This is the core catalyst. Around 40% of RippleNet's 300-plus institutions are actively using XRP for real settlements through ODL. SBI Remit continues expanding Asian corridors. Santander and SCB Thailand are processing production-grade transactions. ODL now touches 80% of global remittance corridors, creating sustained liquidity demand. 4. The supply squeeze getting tighter. Flare Network will lock 5 billion XRP by mid-2026. ETFs removed another 500 million. Exchange supply has dropped to 1.6 billion tokens, the lowest in 7 years. When supply falls and demand rises, price tends to follow. 5. RLUSD unlocking. Enterprise adoption. Ripple's stablecoin sits at $1.3 billion supply since its December 2024 launch. The breakthrough is simple. Banks settle with RLUSD while using XRP for instant liquidity. This solves the volatility concern that held pilots back. SBI Remit and BNY Mellon are early adopters. 6. A macro tailwind returning. Goldman Sachs expects 2 more Fed cuts in 2026, targeting a 3.25% range. Lower interest rates historically redirect capital into crypto because liquidity rises and risk appetite returns. 7. The banking charter wildcard. Ripple applied for federal bank status in December 2025. Approval in 2026 opens direct Federal Reserve access and unlocks XRP exposure for pensions and insurers. Catalysts that could push XRP toward $5 and beyond. Now that we understand the catalysts, the next question is unavoidable. What does this actually mean for price? Not predictions, not hopium. Just scenario modeling based on liquidity, supply, regulatory posture, and real institutional flow. This is where many analysts get it wrong. They jump straight to numbers without understanding that XRP's price is now a function of macro structure, not retail excitement. XRP's next move will be dictated by how quickly institutional rails build, how fast ETF demand accelerates, and whether ODL volume continues scaling. So let's walk through the three price scenarios: conservative, bullish, and extreme, and what would need to happen in each case. Conservative, 3.5. Achievable with continued regulatory progress, ETF flows, and broader banking integration. Requires two OZARs to hold as support. Bullish, 5.8. Aligned with Standard Chartered's model, if ETF demand remains strong and clarity sustains momentum. Extreme, 10+. Only possible with all catalysts firing, banking charter approval, major institutional allocation, and ODL volumes rising from $15.20 to over $50 annually. Before we talk about upside, we need to do what very few channels are willing to do: address the risks with complete honesty. Every strong setup has weak points. Every bullish thesis has blind spots. And ignoring risks doesn't make you a better investor. It makes you an easier target. XRP has real momentum, but it also has structural vulnerabilities, technical barriers, adoption gaps, legislative uncertainty, and macro fragility. These factors don't invalidate the bullish case. They refine it. So to understand the full picture, let's break down the 6 key risks that could slow or derail XRP's 2026 trajectory. 1. Technical weakness. A death cross signals potential movement toward 125, heavy resistance at 241 with 1.56B XRP accumulated, creates a supply wall. 2. Utility gap. Active addresses collapsed 94% from 600,000 in March 2025 to 38,500 in December. Banks can use RippleNet messaging without touching XRP, keeping network activity suppressed. 3. Whale distribution. Early holders booked $721 million in profits, using ETF liquidity to exit positions. This selling pressure can suppress breakouts. 4. Legislation lag. The 2025 government shutdown killed near-term crypto policy. XRP fell 33% during that period. If the market structure bill is delayed past Q1 2026, institutional unlocks stall. 5. Competitive threats. Ethereum-based stablecoins continue growing. If they dominate settlement rails, RLUSD's role weakens, reducing XRP's strategic leverage. 6. Macro stress. A yen carry trade unwind, geopolitical instability, or AI-driven market shocks could trigger a risk-off move, hurting high-beta assets like XRP. Now let me pause right here, because this is exactly what separates early builders from late followers. Projects like Unic are moving in the same direction, building the rails before the crowd arrives. Unic isn't chasing the hype. It's building the off-ramp layer of Web3, a decentralized OTC ecosystem where liquidity, staking, and pre-market trading happen before the mainstream even catches up. That's what smart positioning looks like. XRP is getting its institutional on-ramp by Unic. It's building the user-side off-ramp, bridging on-chain alpha to real-world utility. And when both ends of the system connect, that's how full financial loops are born. XRP is starting 2026 with its strongest fundamentals to date: regulatory clarity, ETF infrastructure, ODL-driven bank usage, and improving macro conditions create a legitimate pathway to $5+. But execution matters. The gap between banks using RippleNet and banks generating persistent XRP demand is still wide. RLUSD must convert messaging-only clients into full ODL participants. Legislation must pass. ETFs must continue absorbing supply. And the key levels, 241 and 3.0, must break with volume. If those conditions align, $5 becomes realistic. If $2 fails to hold, the next range is $150 or $180. The story has never looked this promising. But now the market needs Ripple to prove that utility at scale actually drives demand for the token.